Hello everyone, David Raffanengo coming to you from Keller Williams here in Vienna. I'm in my office here in what we call the bold room with all these bold statements on our wall, the purple room that we call it. In any case, today we are going to be talking about how do I fix my credit to buy a home. So a lot of people ask this question, they don't understand how credit works with getting approved for a loan. Sometimes they think their credit's worse than it really is. But if it's not as great and optimal shape that it should be to get a loan, we're going to talk about how to get some steps to take maybe to get that fixed. So yes, lending has gotten stricter since the 2008 real estate debacle with the crash. And one of the big reasons this happened was because lenders were really just giving loans to anyone that had a pulse, right? If you're breathing, you would get a loan. That's changed since then. Obviously, in 2014, the CFPB, the Consumer Financial Protection Bureau, actually came up with some stricter guidelines for lenders to follow. And the big concern was they wanted to make sure that the borrower or the consumer had the ability to pay back. Okay, so the things that they really look at obviously are credit. DTI is huge. The DTI is the debt to income ratio. Debt to income ratio, we talked about this before. It's basically what's coming in income and your total debt that you have. So your total monthly debt. So if you have a $10,000 credit card, they're really looking more at the payment, the monthly payment for that credit card, or your card payments. All the monthly debt divided into your income, it gives you what we call a DTI ratio, debt to income ratio. So lenders don't want that to be typically more than 50% or less. So that's something that's very big. They want to know that you'll have enough to make your mortgage payments and keep up with your mortgage payments. The other thing, of course, is income. They want to make sure you have a stable, consistent income. If you have a salary job, it's typically never an issue. If you're self-employed, there's some sort of more documentation things to provide for the lender. But credit is the starting point. Credit is, what lenders want to know, because that's the starting point. Based on that, they can make decisions on, do we need things that we need to remove from this credit? Do we need to pay off this one credit card? And that's going to help us bump our credit up. But some of the things to consider in terms of credit. So most lenders will work with a 600 or higher credit score. Below that, it gets a little harder. Up to 580, there's some lenders that can pull that off, but for the most part, they want to see at least a 600 credit score or higher. Obviously, the higher the better. If it's above 700, then you're pretty much golden. I mean, you can get pre-approved or approved rather for a loan pretty quickly. So, but if it's not ideal, what if your credit's not great? Some things to look at. So lenders typically look at the middle score. What that mean is there's three credit bureaus, right? So there's TransUnion, there's Equifax, and there's Experian. If of these three credit scores, say you have a 700, one has a 700, the other credit bureau has a 720, and then the other one has a 740. They're going to look at the 720 as your middle score. That's the score they use to kind of base off to know what your credit score is. One of the things to look at for credit in terms of to consider is the amount of credit lines. So every card payment, every credit card payment, those are credit lines. You want to have credit lines. That's actually a good thing. You just don't want to have too many. If you have too many credit lines, right? If you have 10 credit cards, the lender's going to get a little nervous. The underwriter might get a little nervous that what if one day you wake up and you decide to max out all your credit cards? That's going to be a problem, right? So too many credit lines might be a problem. Having 2 or 3 or 4 credit lines is a good thing. The other thing to look at is your balance, right? Your balance compared to your limit. So if you have, say, a $5,000 credit line on a credit card, you don't want to be at $4,900 limit or balance, right? You want to make sure you have at least 50% or less of your total limit spent. The other thing, a question I get all the time is, David, I'm making all my payments. I pay off my credit card every month, right? They spend $500 and then the next month they pay it. That's actually not good. Some people don't understand why that's not good, but having credit and having a monthly credit payment every month and keeping up with that payment consistently is what people want to see. They want to see that consistent responsibility of being able to pay it. It's a good thing to have credit. Paying it off completely actually doesn't help you build credit. So It's a good thing to have credit, just don't go too high. The other thing is, lastly, is disputing things that are on your credit that you may have already paid off. It's an old account that just, for some reason, is still lingering on there. Those can be disputed many times, and sometimes simply disputing that, literally a few days later, a few weeks later, a month later, your credit score could go up another 20 points and make you qualify for a loan where before you couldn't, just because there's some blemish on your credit. So these are the main things to look at and consider in terms of credit. I hope this was helpful for you and useful. As always, my name's David Raffanengo here with Keller Williams Realty in Vienna, and please subscribe to my YouTube channel if you like this. Give it a like, share the post, and I look forward to providing more value in the future. Thank you so much. Bye.